All right, let's talk taxes. The brand new 2026 tax numbers are officially out, and trust me, they're going to have a real impact on your finances. We're talking about everything from your paycheck to your final tax bill and even your investment strategy. So let's break down exactly what these changes are going to mean for you.
So, this is the big question on everyone's mind, right? With all these new numbers and adjustments, are you actually going to pay more or less in taxes? Well, for most people, the answer really depends on your income and, more importantly, how you adapt to these new rules.
And here's the twist. You'd think that bigger deductions mean a lower tax bill, but that's not the whole story. Because of how the tax brackets have shifted, a lot of people could actually end up paying more. Let's dig into why that is.
Okay, so first up, let's break down the numbers, starting with the new standard deductions. We're going to see pretty clearly why a bigger deduction doesn't automatically equal a smaller tax payment. Now, at first glance, this looks like pretty good news. I mean, the standard deduction for a single person is going up by $350, and for a married couple, it's a $700 increase. But we really need to look closer at what this means for your actual bottom line. So what does that $700 deduction actually mean in your pocket? Well, if you're a married couple in the 22% tax bracket, that bigger deduction only saves you about $154 for the entire year. It's nice, I guess, but it's not exactly a game changer. And that's why understanding the tax brackets themselves is so incredibly important.
All right, let's get to the real meat and potatoes here. The 2026 tax brackets. This is where you're going to really see the impact of all these changes.
But before we jump into the bracket numbers, we have to get this one term straight: taxable income. This is not your salary, okay? It's the amount of money you're taxed on after you've subtracted all your deductions, like that standard deduction we just talked about. This is the number that truly matters. So here they are, the 2026 tax brackets for you single filers. It's so important to remember that these are marginal rates. If your taxable income is, say, $60,000, you are not paying 22% on that whole amount, only on the portion of your income that falls inside that specific bracket. And for those of you married filing jointly, here are your new brackets. You can see they've expanded a little bit, about 3%, which means you can earn a little more before you get bumped up to the next rate. But here's the sneaky trap that a lot of people fall into. It's called bracket creep. You know, a promotion, a year-end bonus, your RSUs vesting, or even just some income from a side hustle can easily push you into a higher tax bracket, sometimes without you even realizing it. Okay, so we've talked about the rules of the game. Now let's talk about the part you can actually control. We're going to shift from the numbers you can't change to the strategic moves you can make to actively lower your own tax bill.
This right here, this is probably the most important thing to remember. You can't change the tax rates the government sets, but you absolutely can control how much of your hard-earned income gets taxed in the first place. And that's where the savvy use of accounts like your 401k, IRA, and HSA comes into play.
Let me show you just how powerful this is with a quick, simple example. Let's say you earn $150,000. If you max out your traditional 401k contribution at the new limit of $24,500, the IRS doesn't see $150,000. They only tax you on $125,500. That one move can keep you solidly in a lower tax bracket and protect your raises and bonuses. So, knowing these limits is your first step. Think of them as your toolkit. For 2026, you can stash up to $24,500 in your 401k if you're under 50. The IRA limit is $7,500, and for an HSA, it's $4,400 for individuals and $8,750 for families. Every single dollar you put in here helps lower that all-important taxable income number. But I have to give a special shout out to the HSA because it's the undisputed superstar of tax-advantaged accounts. It's the only one with a triple tax advantage. Your contributions are tax-deductible, your money grows tax-free, and you can pull it out tax-free for medical expenses. And here's the pro tip: if you invest that money instead of just spending it, it basically becomes a stealth retirement account for all your future healthcare costs. Okay, let's switch gears a bit and talk about investing because smart tax planning here can make a massive difference. We're talking about capital gains, the taxes you pay when you sell your investments for a profit. Now, the difference here is super simple but incredibly powerful. If you hold an investment for a year or less and then sell it, any profit you make is taxed at your regular income tax rate. But if you hold it for more than 1 year, you unlock those much, much lower long-term capital gains rates. The timing of when you sell is everything. Just look at this. In 2026, if you're married and your taxable income is under about $99,000,
you could pay 0%, zero, on your long-term gains. Above that, it jumps to 15 or 20%. But, and this is a huge but, there's a crucial detail that a lot of people get wrong. This is the part that trips almost everyone up. Your regular income from your job, your salary, it fills up these tax brackets first. Your investment gains get stacked right on top of that. So let's say your salary is already $110,000. Well, you've already blown past that 0% tax bracket. That means any long-term gains you have will automatically start getting taxed at that 15% rate. Your salary can literally push your investment gains into a higher tax bracket. Okay, we've gone through a lot. Let's take a breath and pull all of these pieces together into a simple, clear strategy for 2026. Look, the most important thing to get is that your taxes don't change because of one single rule. They change based on how all these rules stack together. You have 4 main levers of control. Know your bracket, max out your deductions, use those tax-advantaged accounts like your 401k and HSA, and be smart about the timing of your investment sales. If you can get a handle on these 4 levers, you can keep thousands more in your pocket. It's that simple. A lot of folks are going to be caught off guard when they file their taxes in 2027, but not you. Now you know exactly what's coming and how you can prepare for it. The only question left is, are you ready to actually use these rules to your advantage?